We're Compound Everything, and we talk money markets investing. And last week we talked about bonds. And so we're going to carry on that conversation this week and go a little bit deeper, I guess, into what is a bond and how to value them.
So bonds, boring.
Big time.
so why are we talking about bonds? Well, bonds have piqued my attention, I guess, because interest rates are starting to go up.
Yeah.
And so what was over the past few years not a very attractive instrument in my estimation is now becoming much more attractive given the yields on the bonds.
In a lot of people's estimation.
Right. So I think that's why we're looking at this a lot more now. What is a bond? A bond is basically just a loan that if I were to purchase a bond that I'm giving to a company or a country that I'm lending them money with a promised coupon payment or a series of cash flows, which is a coupon, and then return of my principal or my money at the end of it.
Yeah.
So essentially, if you look at it, a mortgage is a little like a bond.
Yeah. And
So
we talked about that.
We talked a little about that last time. So we talked about bonds being secured versus debentures being unsecured and whatnot. So what are things that you should know about bonds as a beginner? So firstly, they always start with something called the face value. So for instance, you'll have something that might read $1,000 par value, 6% semi-annual bond that matures in, call it December of 2025, that trades at $108.
Right.
Okay, so what does all that mean? So the face value is essentially the bonds are sold in denominations. And we went a little bit through that last time. So they could be sometimes as low as 1,000 versus upwards of millions if it's institutional buyers and whatnot. And so, but oftentimes there's a minimum investment that's required. So it might be 1,000, 5,000, 10,000, whatever.
Yeah. And unlike stocks, you need to have more capital generally to buy into bonds. So in stocks, you can have fractional ownership.
Right.
So they're making it really easy for people to get in and get out
Right.
of the equity market through fractional ownership and whatnot. But with bonds, it does take a little bit more capital in order to enter into the market.
It does, yeah. And so as you're looking at a bond quote, so if you pull up you pull up your broker, you can often go through your own
Can't
brokerage.
pull up your bond app.
No, you can't pull up a bond app. There's no bond app, funny enough,
I've
even though
never
the market
actually
is much
looked.
larger.
I've never actually looked. I just know
Well,
the default. I have the stocks default app on mine.
Yeah, there's no app that I'm aware of other than something called C bonds.
Oh, okay.
And I think it may require a subscription or something.
Okay, everything with bonds does.
Yeah, which is interesting.
It's crazy. Even when I was trying to look into certain formulas on how to value bonds and coupon payments and all of that, I wanted extra questions just to know that I was ready and prepared for the test. And every single site that I found that had extra questions wanted me to pay in order to unlock the answers, which I didn't.
Right.
Because I was like, I'm pretty sure I can figure this out on my own.
Right, exactly.
For free.
Right.
Yeah.
And you did.
And I did, yes.
So I think that partly the reason for that is because oftentimes bonds trade through dealer markets.
Yes.
So
what is a dealer market?
So a dealer market is essentially where you'd go through your broker and they would have some inventory of bonds of their own. And if you wanted to buy, you can buy them from your broker for a spread. So they bought it at some dollar amount and they'll charge you maybe a little bit more than that and they make the spread. And so there's that way to do it. Or if you are maybe wanting a bond that they don't carry, you may call them up and they say, yeah, we can look into that. Mm-hmm. They'll shop around for it, get it for you, and then take a spread off of that.
It's just so crazy to me how the bond market just seems so like prehistoric.
It's very funny that way.
Like
the stock market has evolved.
Yeah, the stock market and how people can't get in and out of equities has evolved with tech, but the bond market just seems so ancient.
It does seem antiquated.
Like I have to pick my phone up and actually talk to someone.
Right. Now, granted, we can do that. We can off our brokerage website, we can easily buy bonds
if they have it.
If they have them,
if they have them,
stock.
But if they don't have them, we have to actually call.
Right. If you go on the brokerage website, you may find they have certain ones in stock. If you have a different broker, they may have other ones, and it's the way it is.
It's the way it is.
It's the way it is. So what happens if you log on to your broker and they have a bond quote like I described before? So $1,000 face value, 6% coupon, semi-annual, matures on let's say December 2025, and is currently quoted at 108.
Yeah.
So what does all that mean? What does all that mean? So $1,000 is a face value, or the amount that you have to invest. So you can invest in more than that. So you can maybe give them, $5,000, or you could give them $10,000. But the face value is what you're going to get back. Yeah. Okay. And the face value is not necessarily what it will trade for.
Right.
So it may trade at a premium or it may trade at a discount depending on what the interest rate or the coupon of that bond is. So the face value is what you're going to get back at the end.
No matter what.
No matter what.
Whether you pay...
Unless the company or the institution that you're lending the money to goes bankrupt.
Oh, yes, that's true.
So there is default risk.
There is default risk. But, if you're paid a premium or a discount, it doesn't matter. You will get the face value back.
You will get the face value back. So that's a known.
Yeah.
Okay. So face value is also called par value. There's other terminology
And
for
one
it.
thing we should say, too, talking about a company going under, is that the bond payers get paid out first.
Typically, yes.
Before the
shareholders.
The shareholders.
Yeah.
The shareholders usually end up with nothing.
Yeah.
But the bondholders get paid out after they liquidate everything, and whatever money is left in the company is the bondholders who get paid out
Yeah.
first.
So typically bondholders will rank, highest in terms of repayment, and then there may be some senior debtors ahead of them. But the equity holders or the shareholders rank below everyone.
Yeah.
Typically.
Yeah.
So going back to our breakdown of bonds. So you've got your face value. So let's say $1,000. So, and then a 6% coupon. So what does that mean? Well, at intervals, if it's annual, you'll get $60 a year, or if it's semi-annual, you get $30 twice a year of interest payments.
Quarterly, you divide by four.
Quarterly
times,
divide by
yeah,
four,
a
so you
year.
get $15
On and
every. They can go as frequently as monthly, is my understanding, but that's a little less typically. So you will get your coupon payment at intervals, whether it be annual or semi-annual or whatever other interval that bond is obliged to pay out. And then the maturity is the day you get your money back.
Yep.
So when I
December
said December 2025 or 2026, whatever I said, I can't remember, you get your money back plus the last coupon payment.
Yeah.
So you get your $1,000 back plus a $60 coupon payment or a $30 coupon payment if it's annual or semi-annual.
Yep.
And then the price will fluctuate, as I alluded to before. So
the price is what we're trying to figure as a bond buyer or seller, we would want to know what is an appropriate buy for this bond.
Yeah, so all bonds will essentially sell initially for face value initially.
On
So
the primary market.
on the primary market, and then they get disseminated. So the price of a bond will kind of move up and down depending on a number of factors in the market. So right now the most prevalent one is interest rates. So as the Fed is increasing interest rates, people are going to demand more from bonds because they can get higher interest elsewhere. Yeah. So why would you buy a bond paying 2% when you can get essentially
in, say, a riskier company?
In a riskier
you can get
company,
a government bond for
pays
4 or 5%.
Correct. Yeah. So point is you wouldn't. So that bond will then drop in value to make up for that lack of coupon payment.
Yeah.
So that's what we're going to try and figure out today is how do you figure out what you should pay for a bond and what is the yield you're going to get from a bond at a certain price. Okay. So that's what we're going to try.
So
and
you're
do
going to
today.
walk us through this.
There's a couple ways you can value a bond. You can either do it manually, which is quite tedious, and
by
it can be done.
Manually, you just mean pen and paper,
algebra,
a bunch of numbers.
It's not hard, but it is tedious, and it's probably actually a good exercise to do it, just so you understand what's actually happening with discount rates and all that, and just seeing how those coupons are being discounted as time goes on. So a coupon that you receive a year from now is going to be worth a little bit more than a coupon that you receive 2 years from now, and then that'll be worth a little bit more than a coupon you receive 3 years from now, and so on and so forth. And then till ultimately you get your principal back, which is going to be worth less than it was when you lent it because of as time goes on, inflation moves and the value
of money.
Yeah, the money is worth less in the future than it is today.
Yeah.
Bottom line.
Yeah. Now, so there's a couple formulas.
Yep.
And this is for bonds, not T-bills. Because for T-bills, you don't really need a financial calculator. It's
No.
a simple enough equation that you can just literally do a pen and paper.
Yeah, and we can go through that at some point.
But for yield to maturity, which is what would my yield be when all my payments are done and I've received back the face value, we want to know what that percentage is to make it worth our time and worth our while and worth locking our money up. Because your money's going to be locked up in this bond for however long. If it's worth it for us, if that yield is worth the lockup of our cash.
That's right. So at this point, we use a financial calculator. There's a couple different ones.
This is my favorite one.
This is the Texas Instruments BA2 Plus.
I'm sure you can get these on the phone, but I actually like having the physical calculator.
It's nice because actually this is the row of buttons you really need right here. They're all in white on this calculator. And this is the third row down. It's
Which is why this one I find is a little more intuitive than the Sharp.
Yeah.
But the buttons on the Sharp are nicer to press.
They are,
These ones are a little sticky.
These are a little sticky. So these are the only buttons you need to value any bond.
Yeah.
So Let's do a little example here. So we should go backtrack a little bit and say all bonds are going to be calculated on the basis of 100 as a par value.
Okay.
So that's just the standard reference point. So if you're seeing a bond trading at, let's say, $98, that's based on a par value of 100. So if you're to buy the bond at the quoted price of 98, you'll buy it in certain increments. Maybe you put $5,000 or $10,000 in, then you'll still get $100 face value back.
The future value, the FV number is always
going to be 100.
Always 100.
So let's do an example. So I have here a 5-year bond. So I'm just making up an example. A 5-year bond that is paying 8% coupon, and we're going to assume a discount rate of 10%.
So before we get going, can you explain where you would get your discount rate and how you would, because that is one thing you do have to decide on. We'll call it a windage discount rate.
Yeah.
Because the investor has to decide what the appropriate discount rate is for them. So how would you find your discount rate?
The discount rate is essentially the yield I feel I need to get to make it worth my while to invest in this bond.
Okay.
So that's what my kind of hurdle rate is. Okay. So let's say I have a company, and maybe it's maybe a little more speculative or whatnot, and I'm going to say, well, you know what, I'd like 10% on this, because let's say I can get 4% from a longer term government bond right now, and that's risk free. So I'm sure the government's going to pay me back. But this company, there is a default risk to it.
Yeah.
So plus inflation's going to play into that too, and I'm not sure where the inflation rate's going, and maybe the Fed's going to actually be increasing interest rates a little bit more. So I don't know, I'm going to say 10%.
So you've got to compensate for all that risk.
So you got to compensate for all that risk. And there's a number of factors that go in through there. And also there's the time part of things too. It's a 5-year bond as opposed to maybe a 1 or 2 year bond.
Your money away
so I'm
for
locking
quite some time.
my money in for longer. And so a lot of things can happen in 5 years. I don't know.
Yeah.
So these are all things that you've got to account for that. So I'm just going to pull a number there and say 10%. And there's reasons you may choose numbers higher or lower, which we won't get into, because this is just the mechanics we're teaching right now.
Yeah.
So you go through, you put your calculator on there. And so the first number I'm going to put in there is, because at this point I'm going to assume it's an annual bond. Okay, so it's paying interest payments annually. And so I said it matures in 5 years from now. So you go from here, you put 5N is 5 interest payments, or 5 coupon payments.
Number of payments.
Yeah, number of times it compounds.
Yeah.
And so for the next part, I put, because I said my discount rate was 10%, I put 10, and then I hit the IY button. So that assumes that the yield I want is at least 10%. What is 10%? And then I put the payment, and I said it was an 8% bond.
Yep.
So I put, based on $100, I'm going to get $8 at the end of the year. Right. So then if you noticed, I put 10 as the IY. You don't actually put it as a decimal or anything like that. The calculator assumes it's a decimal. And for the payment, you put the cash value of the payment.
Yes.
So in this scenario, because I said it was an 8% bond, we're assuming a face value of 100. That's $8.
Exactly.
So you put 8 as the payment. So I hit 8 and then hit PMT. And then for the future value, we said that it's always $100. So you hit 100 FV. And then you hit compute, and then you hit present value, because that's what we're looking for, how much we should pay. And I get a value of negative $92.42.
Okay.
And so what does negative mean? Well, why is it negative? Well, that means cash is going out. So I have to make a purchase.
You're putting out the cash.
Yes.
That cash is coming out of your bank account.
That's right. So when it returns, when you're putting in positive numbers, that means it's a cash inflow to me. When I'm putting or doing a negative number, that means a cash outflow.
Right. So what this is telling me is that if this bond is worth buying, if I want to see a 10% return, then I need to buy this bond when it is $92.42 or less.
Or less. So if you can get it for even less than that, even better. So you're getting a minimum return of 10% at that point. And so the other thing to remember with this is that you're assuming that each of those coupon payments can be reinvested at the same rate of 8%.
Right.
That's the only catch to this.
Right. They call that the reinvestment risk.
That's the reinvestment risk. And maybe we'll deal with that maybe a little later or next video. We'll see.
Right. That does make a big difference, though, because if the reinvestment risk is real, because if you go and make some, pretty bad investments with the money you're getting paid back on, well, all of a sudden, this yield that you've taken time to figure out, it doesn't matter.
That's right. Yeah. So your reinvestment risk, the other thing is if interest rates go up. So if interest rates go up, you can actually get more, because you can each of those coupon payments is going to be generating more cash flow because
Exactly.
instead of getting 8%, maybe you get 9% or
Right.
10%.
And that's where the real risk comes in with bonds, is that you don't know
You don't know.
what that reinvestment risk is going to look like
Right.
as the bond continues.
Yeah.
Which is why if the bond is longer in length, it's considered
Yeah.
more volatile.
Yeah. Now, as an aside, there's something called zero coupon bonds, and I don't want to confuse you, but a zero coupon bond is a bond that doesn't have any payments except at the end.
Yes.
What ends up happening is they sell it at a discount, and then so let's say it's $100 par value, they sell at 90, and then later on you get your full $100 back.
Right.
And so that does not bear reinvestment risk.
No.
It is a zero coupon bond, but that's a bit of a side.
Yeah.
So we decided that, or we calculated that a bond that pays 8% over 5 years, the face value of 100, with a discount rate of 10%, is worth buying at $92.42 or less if it's compounded annually. What happens if we do a semi-annual bond? In this case, because it's semi-annual, you get 10 compounding periods over 5 years. So it happens twice a year. So you're going to do 5 times 2, which is 10 is your N in this scenario. So you put 10 and then you hit the N button. And then in this way, though, I have to actually half my discount rate. So in this scenario, because it's 10%, I'm going to have to cut that in half. My discount rate then goes, my IY is 5. So then I hit 5 IY. And then again, as you've said, I'm going to cut my coupon payments in half because I'm getting them twice a year rather than every year. Once a year, I should say. So then I hit 4 as my PMT. And then my future value I know is always 100. And I hit that as 100 and then hit FV. And then I do compute, present value, PV. I get negative 92.28.
So a little bit less.
So a little bit less. And this is an interesting thing about bonds is that the more frequently it's compounded, the more the discount that applies.
Yeah.
Interestingly enough.
Yeah, I didn't know that.
I didn't know that either until you
realize-
started really calculating.
Until you start
going through.
calculating
Yeah.
that if you are getting your payments, your coupon payments, more often, it actually changes the value. I would have just assumed. I mean, it makes sense, but I
Right.
just always assumed, without thinking too
Yeah.
much about it, that it wouldn't matter.
Yeah. So let's go in reverse now.
Okay.
So because we said that if you know 4 of these inputs, you can calculate the 5th one easily.
Yeah.
So let's say you have a quoted price for a
It's
bond.
pretty much grade 9 algebra.
It is pretty much great algebra.
Honestly, like if you know almost every number,
Yeah.
you can.
So let's go backwards. Let's go and say that we'll use our semi-annual one because it's a little bit more complicated. We'll run through the example again. So let's say we want to, we're given a quoted price for a bond.
Okay.
The quoted price for a bond, let's say, is you have a bond quote for this bond. It's a 5-year bond with an 8% coupon, and it's quoted at $92.28.
Okay, so now we have
And it's
that.
a semi-annual payment. Okay. What is that bond going to return to me? So what's the yield to maturity on this bond? So the yield to maturity on that bond will be calculated like this. So if you go back and you put 10 as your number of compounding periods, so you hit 10
And we do
as
10
N
because we
because
have
it's
to
5 years multiplied by 2. And then you're going to skip the IY button because that's going to give you your yield. Okay. And your present value we know is negative 92. So if you get 92.28 and then hit the plus minus sign, that makes it a negative. And then you hit PV because that's your present value. That's what you're going to be paying
Because
for.
we know what we're going to pay. We don't have to decide what we should pay.
Right.
They're telling us.
They're
if you
telling
wa-
us
if
this
you
is the
wanna-
quote.
If you want to buy this, you have to pay this much.
That's right. And so then if you also know the coupon that you're going to get. You're going to be getting $4 every 6 months. So at that point you hit 4 PMT, and then future value again is always 100. 100 FE, and then you hit compute IY, and you get 5. You go, wait a minute, what 5? What does that mean?
Yeah, that's not very good.
That's not right.
And that doesn't even make sense.
That doesn't even make sense.
Yeah.
But then you got to take that 5 because remember, it's a semi-annual, so you take that answer and you multiply it by 2, which equals 10.
Good.
So you got your 10%. So if you were to play around with that calculation a little bit, let's say you could find the bond for cheaper. Let's say the next day it drops to $88.88.
Yeah.
So what is that going to return
And you
me?
can see now, just doing this, why bonds are looking more and more lucrative
Mm-hmm.
as interest rates are heading up.
Let's say we got this bond, it's $88.88. It
Perfect.
drops,
Yeah,
right?
it drops.
It's a nice round number.
Yeah.
So again,
There's an interest rate hike.
There's an interest rate hike
And bonds dropped.
Bonds dropped. So then you again go 10 as an N, because that's, again, you have 5 years and 10 compounding periods. And then you skip the IY for now. And then you hit the present value of 88.88 and do a negative and then hit present value because
That's cash going out.
Because cash
you're
going
gonna
out.
have to pay 88, so that's for the negative.
Yep. And then you're going to hit 4 as your payment. And then you're going to hit future value of 100 FV, and you hit compute, IY, and that gives you 5.47.
Good.
But then you remember you have to multiply that by 2. So multiply that by 2 because it's semi-annual, and you get 10.95%.
So it's almost a whole percent.
It's almost a whole percentage more.
So a couple things that we should talk about if we're talking about bonds that we've noticed that people who don't invest in bonds or trade bonds understand is that bonds are annualized.
That's right.
So when I say that, what do I mean?
So let's say you have a 4% bond that's trading at $98. Okay. And it's maturing in 6 months from now. One of the common mistakes that people look at is they say, oh, 4%, but why is it trading at $98? Should I be getting $4 back? The answer is not necessarily. Right. You'll really get $2 back. The thing to remember is that these returns are annualized. It's on an annualized basis. It's 4% held annually. If you're buying it and there's only 6 months left to maturity, you're not going to quite get 4% on all your money. You're not going to get a 4% yield.
Yeah.
You're going to get basically a 4% yield to maturity.
Yeah. And people don't get that because we have seen in bond forums and whatnot that people are like, oh, this is expiring in 4 days. Am I going to get 4%? Right. On this in 4 days? This is a no-brainer. And it's like, no, bonds are annualized. Right. So I saw in one forum a guy saying, oh, I just found a bond. Okay. He just said it's trading at 3.78. I'm going to make $3.78 in 4 days.
Oh, on a $100 face value.
Yeah, and then everyone.
That seems like the deal of the century.
Yeah, that's what he said. He literally, I think it was titled like, "This is a no-brainer."
Right.
Right. It was titled, "This is a no-brainer. I'm going to get $3.78 back in less than a week."
Right.
For $100.
Yeah.
And everyone was like, "No."
Right.
But the thing is that it's actually not uncommon for a comment like that to come into a bond form with people who are new because they don't realize it's annualized.
Right. So the mistake that person's making is they're calculating what's called the current yield of a bond.
Yes.
So they were looking at those numbers and assuming that's what they get, not realizing that those interest payments will actually have been paid to somebody else.
Yes. And so we have to remember there's yield to maturity, which we were finding, and then there's the current yield.
Yeah.
And the current yield is calculating something very different.
Yeah. Basically what that is almost like trying to figure out the dividend yield of a stock.
Exactly.
It's almost the exact same thing.
Simple.
So the current yield is taking the current cash flow that you're going to be receiving from the bond and dividing it by the current bond price and multiplying by 100.
Yeah, and then that's it.
Yeah.
And the other thing to keep in mind when you're buying bonds is the accrued interest, which we won't go into this time because you have to pay that back to the original, to the person that you're buying it from. So if I'm buying a bond from you and we're 3 months past the last interest payment, I'm going to have to pay that accrued interest for that 3 months that you held it before. So you got to actually add that into all your calculations because that really does actually change quite a bit.
Yep.
That gets a little more complicated, but it's something that you do have to learn if you are going to get into bonds.
That's right, bond trade. So that's the point. Like the point being is otherwise people would only trade bonds right at the coupon payments.
Exactly.
But they trade very liquidly oftentimes.
Exactly.
Yeah. So I think that's all we have for today. Maybe we'll go over calculating treasury bills and money markets next time.
Yeah, that'd be good. Treasury bills are much easier. They're much easier to understand and they're much easier to calculate.
That's right.
Actually, so we can summarize that there are a few different calculations that you can use for bonds to value them using a financial calculator, and it's not that hard once you know how to do it.
Yep.
And we can also say that bonds are annualized.
Bonds are annualized.
Bonds are annualized.
Yeah. And just be careful. I mean, what we're doing is giving you information. We're not trying to make any investment recommendations or anything like that.
We're not even saying you should get into bonds.
No. The one thing I would say is if you are getting into bonds, know what you're doing.
Yes.
Yeah.
With any investment vehicle.
With any investment vehicle. Figure it out and then dip your toes in.
Yeah, a lot of people like to get into something that is looking hot or that a lot of people are talking about and they don't know anything. And I have a feeling that bonds are going to come back into vogue pretty soon.
I think you're right.
Yeah. So thanks for watching, and we'll be back in a week or two. I don't know yet because we're going on vacation.
Yep.
And next time we will talk about treasuries.